Hello, good evening, everyone, and thank you for coming to attend our webinar tonight. My name is Richard, and I'll be your host today. And today we are having our OTCS Market Outlook 2024. So if you are here and you have not already joined our Telegram channels, please join our Telegram channel so that you can be kept posted of upcoming events. So for OTCS Telegram channel is Online Traders Club that you can search for within the Telegram app. And for Wealth and Joy is to search for Wealth and Joy. For Wealth Lions is to search for Wealth Lions. And for Invest Kaki is by searching for Invest Kakis. So please join our Telegram channels. And if you're watching us on YouTube, please don't forget to like, subscribe, and share this video. And with that, let me get started by before introducing OTCS, I'd like to always ask this question. How is the market so far? So I know you can't answer the question, but it's okay. Let's take a look at the chart because I firmly believe in using the chart to guide us where is the market today and where we are likely to be heading. So for me, I'll just like to share this one chart, which is the chart of S&P 500. And from here, between the end of October to the end of December, we have a very, very nice uptrend, right? And then when the new year started, SPX kind of like just been chopping sideways between 4,700 and 4,800 levels. So we are still chopping within the 4,700 and 4,800 levels currently. So where is the market? To me, the market currently is having the sideways direction, and the key levels that we need to keep and look out for would be 4,700 as the support and 4,800 as the resistance. So if it break 4,800, expect SPX to continue to go up. If it drop below 4,700, I will expect SPX to go down. Okay, so that's my little insight into where I think SPX is. But today we are here to listen to our two experts to share with us about their insights of where the market is heading. So I will not take up too much of your time. Let me now move on to share with you more about OTCS. OTCS stands for Online Traders Club Singapore, and we are a non-profit society formed in 2005. And we are a community of traders and investors, mainly here in Singapore. And OTCS to me is a place where we network, share, and learn, and we do it through a series of workshops, courses, and our library. For workshops and webinars, we aim to have about 6 to 10 a year, and it is free for our members to attend. And since COVID till now, we have been keeping it free for our members as well as the public. So these are some of the pictures from our in-person events. And for courses, we aim to have about 2 to 4 a year. And normally what we do is that we will do a group buy with trainers to get a discount for our members to attend the trainers' courses. And we aim to have about 2 to 4 a year. And we also have a library, but since COVID, it has been closed. But when we were having it open, there was about $6,000 worth of resources that our members can borrow. So currently, it is still closed. So again, LTCS is a place where we network, share, and learn, and we do it through a series of workshops, courses, and our library. So the fee to join us as a member is $120 a year, but for a time-limited period only, it is $60. And since COVID till now, we have been keeping it free. So if to learn more about us, please visit onlinetradersclub.org. And if you just joined us, don't forget to join our Telegram channel to be kept posted of upcoming events. If you prefer to receive it in email format, do join our mailing list as well. If you're watching us on YouTube, please don't forget to like, subscribe, and share. And here, I'd like to give a special shout out to our OTCS crew. They are the unsung heroes who are working behind the scenes in our physical events, helping us out, such as what you're seeing here, to distribute food and water to the attendees who come to our physical events. So thank you very much. You know who you are. And now for the very important slide, the disclaimer. You are responsible for your own profits and losses. The speaker's opinions are their own and does not represent OTCS opinions. OTCS, its office holders, associates, and sponsors are not responsible nor liable for your losses. OTCS events are for educational purposes only and should not be construed as advice. And when you're in doubt, please seek professional help. So with that out of the way, let me now share with you our agenda for today. We have two speakers. They have been regular in speaking at our Market Outlook events, and they are none other than James Yeo and Ian Low, who will be covering the domain in their expertise, which is the markets, the bonds markets, Singapore markets, US markets. All right, so they may be having some overlaps in terms of the area of coverage, but that's the good thing about having multiple speakers covering the similar areas of so that we can hear different views from different experts. So without further ado, let me now hand over the stage to our first speaker for today, Mr. James Yeo. So James, I'll hand over the stage to you now.
Hi, Richard. Thank you very much. Hi, audience. Thanks for joining this webinar. If you can see and hear me, can you type yes in the chat box?
Oh, they can't type.
Oh, they can't type. Oh,
yeah,
right,
don't
right,
worry.
right.
Can hear and see you because I
Okay,
can
okay,
hear and see
okay.
you.
Can. Okay. Now let me share my screen. Okay. Okay. So I'll be sharing my Google browser because after which during the discussion for the Q&A, as well as if you have any questions on my the stocks that I discussed later on, I will be sharing with you on how I decided to pick up some of these stocks, right, through the different platforms. Okay, so anyway, I'll be going through the market outlook for 2024. Okay, thank you, Richard, once again for inviting me. Okay, so just a quick disclaimer before that. Okay, this presentation is for information purposes only. All right, does not constitute to any form of recommendation or advice. Okay, and the views expressed by me, okay, are in no way my reflective of that. Okay, please make your own decisions, right? This is the disclaimer for today. Okay, so just now Richard already covered the agenda, all right, about the market outlook and how we're gonna have maybe some kind of overlap. Okay, so this is the agenda for my slides, all right. I'm gonna talk about Singapore as well as the US markets. And then I will further dive into the industry sectors. All right. So which are the industries that are gonna be beneficial, or which are the industries that maybe will be kind of a muted growth in this coming year. And last but not least, I will also touch on a few case studies. In particular, okay, some of my own stocks that are on my watch list, right? So I will be going through some of them and why I decided to pick on them. Okay, so without further ado, let's dive into first thing first. Let's talk about myself. All right, if you are not familiar with me, okay, my name is James. Okay, and I have been writing for a lot of famous publications like Motley Fool Singapore. So now they have switched gears to call the smartinvestor.com.sg. All right. Okay. Dollars and Cents, Sidley, Yahoo Finance, and also Investor One. Okay, so there are a lot of investing publications whereby they are all online, and you can actually just do a quick Google search. You can find my name in some of the articles over there. All right. And on top of that, okay, I used to write a lot of articles, and to certain extent, right, I decided to why not, right, go for a skills future cert, so that I can take it up to the next level, so I can get my skills future cert, and then I can go on to teach investment courses, which I will share towards the end of my slides. All right. And okay, so on top of all these, right, I'm actually the founder of smallcapasia.com, and I also started a YouTube channel called Invest Kaki. So for those who are watching this webinar through the YouTube channel, you can actually just go to the YouTube channel and search for Invest Kaki. I believe my face will show up in all the videos, so you can just subscribe to it. Okay, so I'm also SGX Academy speaker as well. I didn't put it inside the text here. So going forward, for this year, I'm more active lah in this, having all these SGX webinars. So because I'm more intertwined with them now, and they have been inviting me to also speak to some of their events. All right. Okay, so if you are interested in following me on YouTube, okay, you can actually scan this QR code, or you can just type it in this link called bit.ly/sub, okay, sub invest kaki. And why do you want to follow me on YouTube? Okay, so it's because of the past videos that I've done. Examples like the Singapore stocks to celebrate National Day. All right, I also covered ComfortDelGro when it was trading at 15-year low. Back when I covered Comfort, it was trading at around $1. Right now, I think it's already $1.40. And I believe, okay, personally lah, right, I think that ComfortDelGro has more room to grow because of all the price increases. So they talk about inflation, and then they are putting in a lot of platform fees lah, surcharge lah, and things like that. And for me, I do use Comfort because of my two young kids, right? I cannot go for Grab car and all that. I have to go for taxi, and Comfort just seems to have more taxis in the running the roads lah, because they have the biggest market share, right? So I bopian, I have to use ComfortDelGro. And that's the reason why I decided to cover Comfort, and I see that the share price has been going up steadily. On the other hand, I do also follow US stocks. So when the US stocks, especially the bank stocks, right, like Silvergate, Silicon Valley banks, when they went bankrupt, I think last year, I actually did a very quick video to cover that versus our three local banks. So we can see the deep contrast, all right, comparing the US bank and the Singapore banks. So I decided to do a quick video on that, as well as the retail REITs. So I cover a lot of REITs because that's what Singaporeans like, right? So if you were to follow me on YouTube, you will be able to you will be able to see a lot of blue chip stocks as well as REITs in my YouTube channel. Okay, so that's all. Back to the main topic for today's agenda, right? The markets in 2024. So, like I mentioned, I will be covering the Singapore market. Okay, you can see that I have a very nice picture over here, and the US markets as well, right? So first things first, let's talk about Singapore first, okay? So we are all familiar with the Singapore market, I presume. Okay, but do you know that in the past 10 years, okay, this chart is extracted just 2-3 days ago. So in the past decade, you can see that our Singapore Straits Times Index hasn't gone anywhere. Okay, so if you were to be vested in the Straits Times Index since 10 years ago, apart from getting the stable dividend yields lah, okay, the price hasn't gone anywhere. So why is it like so I would say still so disappointing in the sense that when you compare to other markets like US, even the Europe markets, all their exchanges have actually been going up, except for Singapore. So let's talk about the Straits Times Index, right? We have 30 constituents in the index itself. And now let's make a guess, okay? How many property related counters are there in the STI index? Okay, I know that y'all cannot type it inside the chat box, but just make a quick guess in your mind. How many property related counters are there? Is it like 5, or is it like 10, or is it like 15? Okay, so without further ado, let me review the answer. Out of the 30 stocks in the STI index, we have 10 stocks that are property related. So counters like CapitaLand Invest, City Developments, Hong Kong Land, all the Maple Tree Trust, and as well as UOL. And not to forget, right, we have a lot of counters that are also invested partially in the property counters. Okay, so we have things like the other REITs or trusts that are vested inside. All right. So now let's take a look at the Singapore economic outlook. So we have two sides. One is the good and one is the bad. For the good wise, okay, I extracted this out from the Singapore government website lah. Okay, the MTI, okay, the trade and the industry. So they are saying that the electronics and manufacturing sector is going to be good after a downturn for the manufacturing sector because of all this oversupply. Even the TSMC, they are saying that there's oversupply and chips are going down and things like that. So going forward in the next year, or sorry, in this year itself, sorry, the sector is going to have increased demand in the global semiconductor sales and a favorable outlook for the AI related chips. Okay, so the forecast will be promising, all right, and this growth will extend beyond this year into 2025 to 2028. So what they're trying to say is that the worst is over, right? So we're gonna have a couple of good years in the next few years, all right? And on top of that, we have F&B, travel, and hospitality. So if you think about it, right, travel wise, a lot of us has been traveling around the world. For me personally, I went to Hong Kong Disneyland just 1 month ago, and I would say that it's bustling with activity. SIA itself, you look at their results, wow, fascinating. Their net profit, their sales are up like more than double digits, right? And this growth, right, has come off like a very strong spring post pandemic. But a lot of the analysts are saying that it will continue to grow going forward, especially, and on top of that, right, our Singapore F&B industry is also projected to grow, although at a very slow pace of around 2% over the next 4 years. It's still growing lah. The reason why, if you were to ask me, is that F&B, right, they are gonna increase the prices. When you think about it, like Ya Kun, Old Chang Kee, all that, they're gonna increase prices. Just like even if they increase by a few percentage, that will trickle down to the earnings, all right, and the earnings will continue to grow. Same thing goes for the hospitality. A lot of traveling means that a lot of people are coming to Singapore. They're gonna visit the Genting Singapore casino. They're gonna visit our hotels. So all in all, right, the hospitality sector will be benefit from all this growth as well. Okay, so we have now let's take a look at the counters itself lah. So we have semicon, travel, and F&B stocks. Semicon wise, we have the counters that I can think of, right, are Venture Corporation, okay, our biggest semicon player in Singapore itself, right, as well as Grand Venture. So Grand Venture has suffered from a very deep cut in all this demand for the for their manufacturing services, okay, and as a result their profits have fallen double digits and all that, but they are very optimistic. If you look at their management commentary and things like that, they are all saying the same thing. So semicon, um, the worst is over in 2023. Looking ahead, they will be cautiously optimistic. Yeah. So if you were to go and look at all these semicon stocks, right, all their corporate presentation slides, they are all saying the same tone. Okay. And travel, so SIA, like I mentioned, right, SIA and Genting Singapore, okay, as well as even those smaller counters like Straco. Okay, Straco is the one that operates our Singapore Flyer. So all these are the management are also very I would say like very positive lah, okay, on the outlook ahead. And then for the F&B, we also have a lot of F&B because Singaporeans like to eat, right? We have Swensen. Swensen is by ABR Holdings. We have maybe the Japan Food. Okay, we have Ajisan Ramen and all that is under Japan Food. And if you were to ask me, my favorite pick would be RENS because I frequently visit Ichiban Sushi. Okay, because okay, my wife likes to go lah, so I will also follow lah. So we even have a membership, the with Ichiban Sushi. So presumably I always eat there and I find their food still okay, still not so bad. So I would like to also showcase this stock line over here. Okay, so now let's look at the poor economic outlook of Singapore. So again, right, based on the Singapore government's forecast, what they are saying is that the banking, financial sectors are going to be uncertain, okay, or maybe they're going to come down a bit due to the very high expectations that the interest rates will come down. So imagine when the interest rates come down, so the banking sector will charge lower interest rates, but at the same time, they are still faced with all the effects of high interest rates. That means all the businesses, okay, maybe they cannot tahan all these high interest rates already. They decided to close shop or they decided to go bankrupt. All these will come, they wouldn't come immediately. They will come maybe a few months or 1 year later. So the banks itself will be hit by all these next wave of bankruptcy, but at the same time they will be forced, when the US lower their interest rates, they also have to lower the interest rates. So they are charging lower interest rates, but at the same time they're going to face all these bankruptcies by their loans lah, so-called the corporations. All right. And other than that, right, we have also all these escalating geopolitical conflicts, i.e., we have Russia-Ukraine war still ongoing after 1 year plus. Still, I don't know how they're gonna continue so long, right? And on top of that, we have also the Israel versus the Hamas, right? So is also escalating into the Middle East versus US, sending all their militaries to protect the sea itself. So this has a very global uncertainty, and it's gonna also disrupt the raw material supplies. And this pertains, I would say, in particular to the Middle East, the route, whereby when there's a lot of disruptions, like the pirates, they are gonna cause disruptions in the shipping industry, right? So that will impact on the raw materials, and then it will impact on all the pricing and the supply chains. So if you were to ask me what are some of the stocks that will be impacted, okay, for the financial and raw material area, of course, is our three local banks, UOB, DBS, and OCBC. Okay, very clear cut are the financial sector. Okay, although if you were to ask me, I think they will still weather it well lah. They are so strong, balance sheet wise. Even if they are faced with lower interest rates and all that, no worries. It's just maybe their profits come down for the year, but all in all, they can still grow their market share outside Singapore. You know, um, so in the long run, they will still continue to grow lah. Raw material wise, okay, so two counters that I can think of is Olam as well as Wilmar. So in fact, if you were to look at their results, okay, maybe they are not so good as compared to the past. So if you think about it, all this is very hard to forecast. Okay, so if imagine if I were to ask you, what is the price of sugar going to be in 1 year's time? What is the price of wheat going to be in 6 months' times? So by and large, as retail investor, we don't have information of all this. Even the corporations, even Olam or Wilmar, they won't be able to know because they are always affected by the global demand and supply. If there's a ongoing war, if let's say Russia decided to block the port in the wheat, right, in the in the Ukraine region or their own port or things like that, so it will impact the prices of wheat, and the prices of wheat will snowball into other things as well. So investing in this kind of a commodity firms is actually a very tough thing to do because even they cannot predict. So more what makes us, right, as average Joe investors, we won't even be able to predict as much, right? Okay, now so I've covered the economic outlook for Singapore itself. I would say that it's a balance lah. It has always been there. STI has always been stable for the past 10 years, and for the coming year, I don't think that there's gonna be much uncertainty. Not much uncertainty, much volatility. So the price not gonna move much. And for the low interest rates coming down, I think it will benefit the property counters. So given that we have 10 property counters out of 30 stocks in the STI index, so that will be beneficial for STI, okay, going forward in this year. Also, that's my take lah, okay. But I'm not a fan of STI index. Presumably, if you look at the past 10 years, it has been going nowhere. So if you want me to pick a few stocks, I will go for two things lah. One is value, and the other one is dividends. Okay. So first of all, when it comes to value, like and to couple with the industry theme, right? So just now I mentioned about semicon, right? Semicon, the turnaround, plus some kind of a value aspect to it. So my watch list is actually nano film. Okay, if you can see how their products being applied throughout the different places, like garage, you have all the fuel cell. Okay, even Temasek is partnering with them to do the fuel cell coating. Okay, you have all these 5G, the mobile phones, the computers, laptops, printers, all of them need some kind of coating. Okay, so this will pertain to nanofilm and their expertise. All right, so nanofilm, I believe will benefit from the coming year turn around, okay, especially in the semicon industry, as well as because it has fallen so much, right? And a lot of investors have given up hope lah on nanofilm, so to speak. All right, so nanofilm. The second one that I want to share is Raffles Medical. So I believe a lot of us are familiar with Raffles Medical. No need to say much. But given that, okay, Raffles Medical over the past 5 years, they also have been going nowhere. Right now, it's trading at around $1 because of their losses incurred for expanding into China itself. But if you were to ask me, right, their core operations still very strong. You have all the Raffles Hospital, you have the clinics. People sick, okay, people still go to see clinics. So more or less resilient and defensive. All right, so this is trading at a point whereby I find that they are doing a lot of share buybacks. So there's some kind of a support area. So this is my pick. The third one, okay, the third one is none other than Tiger Balm. Okay, so Tiger Balm, if you don't know, their counter is Hopa Corporation. Okay, so Tiger Balm, I do use them for myself. So more or less also pretty defensive, a kind of a consumer staples. I think when it comes to inflation, right, they will be able to push up, the prices of all these products, and they also have a big chunk of investments in all the different banks and all that. So more or less, very defensive stock lah. Okay, so given that it has come down by a bit, this is what I would say will interest me lah. So these three forms my Singapore watch list. All right. So now moving on to the US, okay, the US market. So where a lot of us know, because Singapore don't just give the kind of returns that we want, right? So a lot of us like to go to the US market. And when I want to talk about, or I want to find out about the US market valuations, right? I actually go to this website called currentmarketvaluation.com. Okay, it's pretty interesting in the sense that they show different models, okay, which I will go through here lah. The first one is interest rates. So they compare the S&P 500 versus the interest rate. And Warren Buffett, okay, what is the market value of the US S&P 500 versus the US GDP itself? And last but not least, they also compare the cyclical adjusted PE ratio. Okay, so given like over the past decades, the past like 30 years, what is the adjusted PE ratio according to inflation? So now I have already grabbed the screenshot, so I'm gonna share it with you. First one is the interest rates. So they use the 10-year treasury yield rates versus the composite score of S&P 500 value. So they find out that actually this interest rates indicator, right, as depicted by the purple line, is around in the middle, okay, below the 1 times standard deviation. So I would say that this is just nice, not overvalued or not undervalued. Okay, so this model actually look at the relative performance of the US stock market given the current interest rates. The other one that a lot of investors like to see is the Buffett indicator. Okay, and you can go check out the website. They will explain what is this Buffett indicator about. Okay, basically they compare the market value of the whole S&P 500. Imagine all the 500 stocks, their market value, and then what is the GDP of the US economy. So they say that if the market value of all the stocks, right, have gone up by too much compared to what they are making for the economy itself, that means it's a sign that is overvalued. So right now, as of 30 November, okay, 2023, so maybe 2 months back, is at 175%. Okay, so this has come down by a bit since what I've covered, I think last year. All right, when I covered it last year, it was trading above 200%. So it has come down by a bit, but still rather overvalued at the moment. So you can see that the long-term line, maybe it will be at around 130%. So now 175%, kind of high, okay, in relativity. The third ratio I want to share with you is this cyclical adjusted one, okay, where they take the current price divided by the average earnings over the past 10 years. So this will smooth out the volatility, okay. And what we are seeing here is that around 30 30% north of the historical average at 20%. Okay, so the 10-year, okay, cap ratio in the past is around 20%. So right now is at 30%. So it will be overvalued at the moment. So if you were to look at all the three indicators, right now the US market is actually overvalued lah. Okay. Okay, so let's see what the analysts or the economists, the different banks are saying about the US economic outlook. Okay, so first of all, JP Morgan is saying that there is a slow global growth for the market outlook for 2024. And they even say that, right, they are seeing a chance of recession, okay, in the first half of 2024, 25% chance lah, followed by 45% chance in the second half, and the 60% chance of recession by first half 2025. So basically, JP Morgan is saying that they are very pessimistic, okay, of the economic growth in this year and the next. Okay, so now let's look at what Morgan Stanley is saying. Okay, so Morgan Stanley is saying that the US stock market rally at the end of 2023 is also saying that is overvalued right now. So there's very little room for error because it went up so much, right? If any bad news come out, it will be going down, okay? And if there's any good news, maybe it will just go up by a bit, all right? And they are saying that the analyst estimates for the 2024 may be too optimistic. So there will be some kind of a tapering in the US economic growth. All right. The third one, Forbes. All right. Forbes also is saying that US will have recession risk. Okay. Especially when you look at the interest rates, right? They are pressuring US stocks, US corporations. So corporations will also mean that the private companies they are also facing very high interest rates, and all these are coming to haunt them, okay, and they may default, and all these default rates will continue to rise in this year itself. And Forbes is saying that is even more pessimistic. They are saying that there's a 51.8% chance of a US recession in the next 12 months. Okay, so even the US Federal Reserve, they are cutting their economic growth expectations for 2024, expecting a US unemployment rate to go up this year itself. So all in all, right, they are all very pessimistic in this year itself, even though we are talking about lower interest rates lah, lower inflations and things like that. Wow, everyone is so pessimistic. This actually is a because due to the reason that there are being layoffs in the market. Okay, and if you go and check out this website called layoffs.fyi for info, right? layoffs.fyi, you can see that there are a lot of tech companies laying off people in just the few months before this webinar, right? You have Google. Google already lay off, I think last year, a few months back only. And just last week or just in the past few days, Google is cutting jobs again. So we have also Amazon, we have Meta. All of them are earning, so much, earning billions of dollars, and they are saying that, oh, we don't need all these employees. Why? Because of AI. So when AI comes out, all this automation is being done. They don't need so many people. When they cut the jobs, their results will improve. All right. But the impact is that all these people getting laid off, right, will lead to higher unemployment rate and will maybe cause the recession because they don't have the kind of income required to support the property market, support the stock market, and all that. So, all in all, right, all these layoffs are going to play a part. Maybe not now because they have savings, but my belief, my take is that, in the coming year, well, maybe they want to tighten their purse. They're gonna, sell their stock, sell their properties, go for a more simple lifestyle. All this is gonna be have the impact, not so soon, but in the coming year or 2025 itself. Okay, so if I were to summarize the US Outlook 2024, it will be that there is little room for error. Market dynamics in 2023 to continue. So what happening in 2023, like the layoffs, okay, like high inflation, interest rates still gonna remain high. Okay, that's what I believe based on what I've been reading. Even though they are saying that there will be cuts of the rate hikes, but maybe not so much. All right, so the market dynamics still gonna continue, and we also forget. A lot of us forget that there will be an upcoming election, so it will be adding fuel to all this global uncertainty. So Donald Trump is gonna go up against Joe Biden again. So all this is gonna play a part in the very confusing U.S. economy going forward. And let's take a step back, right? We look at 2023, see how is the market performing. Okay, so market for the S&P 500 itself is actually up more than 20%. Okay, very good year in 2023. But a big part of it is actually contributed by this Magnificent Seven. If you go and Google this Magnificent Seven, like Alphabet lah, Amazon lah, all right, all of them are contributing. Actually, all of them, this Magnificent Seven, right? In total, they have gone up more than 70% in the past year in 2023. Nvidia is actually a big stock, it's a big winner there. Okay. And in the past 5 years itself, Magnificent Seven. Okay, you have all these stocks here already, Meta, Nvidia, Microsoft, Tesla. They have returned magnificently, right? Pardon the pun. Okay, so from 2020 to 2024, they have already gone up like maybe more than 300%. And if you were to compare it to Nasdaq and the S&P 500, wow, you will be making a lot more money if you have invested in just these 7 stocks itself. Okay, in the past 5 years. So, if you were to ask me, I would say with all this uncertainty, right, I would like to go for quality stocks. I say that quality will reign supreme. Okay, and this is also backed by a lot of studies, right? Like, especially when you look at studies like this, 1984 to 2021, equity performance has been factored as been as a result of this quality factor and low beta factor. Low beta means it doesn't move in accordance to the market itself. Okay, a beta of 1 means that the stock will move equally with the S&P 500. So let's say a beta of 0.5 means that S&P 500 move up 10%, the stock will move 5%. So the same thing lah, inverse. If the S&P 500 drop 10%, the stock will only drop 5%. Okay, for a beta 0.5 times. Okay, so if you were to take a look, right, over the past decades, quality has reigned supreme. Okay, and I would like to look at the characteristics of high quality stocks. Okay, if you were to want to screen for quality stocks yourself, so these are some of the factors that you can consider. So one of it is strong and stable earnings. So it has been to make money or at least have a free cash flow itself, right? This will be a determinant of these quality stocks. So other things that we look at is economic mode lah, management team, a growing industry, as well as a strong balance sheet. Okay. So you notice that we don't talk a lot about financial numbers itself. As long as they have a consistent growth for their maybe their top line or their profits, and maybe they have been churning out free cash flow. So all this is already enough. What matters more about quality stocks is like whether you have the economic mode to continue this consistent growth going forward. So we are looking ahead lah, not looking at the back. Okay, let me take a sip of water. And if you look at this table over here, you can compare quality stocks versus growth stocks. We are not looking at growth stocks because growth stocks you can see, although they grow very fast, like during the pandemic, they grow like more than 500%, 10,000% or whatever. They also fall pretty fast. All these SIA stocks, like if I were to give an example, like maybe C Limited, okay, Shopee, we have all these specs. All of them went up very fast, and all of them come down very fast also. Okay, so quality stocks itself, they are growing moderately, like maybe 10 to 20%, but they are more steady growth, more sustainable. And I would say that a lot of them are well-established household names. Okay, so I would say if you were to want to find some stock ideas, you can actually check out this Fundsmith LLP. Okay, so this is a fund that focuses on quality stocks. Okay, and is by this very famous guy called Terry Smith. Okay, he created this Fundsmith for many years, and he has very systematic way of finding quality stocks lah. So basically, you want to find wonderful companies, and you don't overpay for them, and then you do nothing. So you let the winners just grow by themselves. Okay. So if you want to take a look at this, I actually did a screenshot. Okay, I put it over here. I actually have access to this website called finchat.io. Okay, it is a AI tool that I can share with you lah. Maybe I just do a quick run through here. Okay, so this is actually finchat.io. You can see that I search for the Fundsmith, okay, the fund itself, and you can see that I've grabbed a screenshot over here. Okay, so you can check out the different companies or their file links, all right, inside here. Okay, so coming back to the slides. Okay, we have a couple of names that we all know. So Microsoft is one of them. Meta platforms with like Facebook, right? Visa, PepsiCo, all right, Alphabet, even Nike. So and also last but not least, Apple. Okay, so all these quality stocks, they grow maybe at a stable pace, but more importantly, over the long run, they'll be able to grow and give you 200%, 300% kind of a returns, like what I shared with you in the Magnificent Seven. Okay, so I think you also want to find out about the US watch list, right? Okay, so now it's 8:20. We will have a bit of time for Q&A. So I will just briefly go through the watch list stocks I have. Okay, so when it comes to my US stocks, I like to follow this Elon Musk advice. Okay, investing advice, which makes a lot of sense lah. Okay, that's why I like to share with you here as well. Okay, so Elon Musk says that he has been asked a lot on how he invests. So he says that you can buy stock in the companies that make products and services you believe in, and so that is buying. So when you sell, you can sell them if you think that their products and services are trending worse. Okay, so buy and sell. So very good. He covered the entire, like maybe what you need to know about investing or finance in just 2 sentences. How to buy and sell. And more importantly, about psychology, he says that don't panic when the market does. So basically, just buy and hold lah. Only when the products and services are no longer good, then you sell them, right? In the long term, you will do good for your portfolio itself. Okay, so with that in mind, I will share with you what I personally use. Okay, so first stock I have is Alphabet. Um, I like to share a lot with a lot of my other, you know, because I conduct investing workshops for Skills Future as well, and I also conduct other webinars. And I always say that I cannot live without Alphabet, because I'm a YouTuber myself. I use YouTube a lot. My phone, I use Android phone, Samsung. Okay, I uh, I have Google Play Store. All right. Whenever I go to somewhere, I use Google Maps, and even my TV is powered by Android. So if you take out Alphabet, I don't know how am I able to function. All my to-do list is also in Google Calendar. So I have a very bad memory, not like my wife. Okay, so if I want to find out what I'm supposed to do in the next hour or the afternoon, okay, or at night, I will just go to my Google Calendar. Okay, I cannot function without Google. This is how important it is to me. The second stock that I want to share is McDonald's. All right, so McDonald's itself, although it's been a very established brand, so many outlets globally, but I believe the power of McDonald's don't lie in the number of outlets. It lies in the fact that they are able to increase the prices every single year. So imagine last time we eat ice cream cone. For my time, when I'm still a student, I don't know about y'all lah. When I'm a student, maybe 10 plus years, like maybe 16 years old, O level. The ice cream cone is only 40 cents, 50 cents. Now it's $1 or $1 plus with this kind of new flavors, kueh bangkit flavor, right? So they can continue to increase price every single year, but you have to pay for it because why? It's everywhere. And secondly, my kids like to go McDonald's, so I definitely have to pay for them. The third stock is a bit of a tech stock. It's called Shopify. Okay, why I want to talk about Shopify is because it's linked to trend that I have I've seen in the past few weeks. The dominant trend is that AI is really taking force. taking impact in the sense of the layoffs, in the sense whereby a lot of jobs are being replaced by AI, and Shopify uses AI to a very good benefit for their merchants. If you go and check out all these YouTube videos by Shopify, right, they are always saying that the AI tools help them to save so much time, in the sense that if you have such a very good AI tool in for the Shopify merchants to use, right, they're gonna use and they're gonna stick around in Shopify, and that will benefit Shopify stock in the long term itself. Okay, so we have Alphabet, McDonald's, and Shopify in my US stock watch list. Okay, so I've come to the end of my presentation. So next, what you can do, all right, if you are looking for more stock ideas, you can actually join my Patreon membership. I've this Patreon that I just started a few months back. All right, it's called patreon.com/investkaki. If I can, I will share this link later down in the chat box later. Okay, so basically in this Patreon membership, I do have a US stock quality fund, okay, which I put in 10,000 of my own money, and I'm going to buy a lot of these quality stocks. All right. So if you join my membership, you can actually follow me through. On top of that, I also will be coming up with a dividend portfolio. Okay, so the 200,000 dividend portfolio, this is based on the 4% retirement rule, because like what a lot of retirees like my dad, right, they always want to find, what are the dividend stocks that can give them some kind of passive income with all these dividend cash flows. And I've spoken to my dad before. He's actually looking for something like this, whereby I just show him, okay, what I invest in. No need for very quick turnaround, but maybe just very quick 10 dividend growth stocks, or 10 to 15. And then on a quarterly basis, I will look at them, or even like maybe when I have any new ideas, okay, I will put it inside this retirement portfolio. More importantly, is giving out at least 4% dividend yield, so you can make sure that all these stocks will give you some kind of a passive income for the year. Okay, so this is it for the stock ideas. You can join my Patreon membership if you want to be um, you know have better investing knowledge, or educated in the sense whereby I will talk about US stocks. So let's say if you're not familiar with US stocks, you want to be educated and in this space. Okay, I'm running this skills future workshop. You can get up to 70% subsidies by the government. All right, it's accredited by Institute of Banking and Finance, IBF, as well as up to 70% skills future credit eligible. So you have I think 1,000, right, for Singaporeans. I can use that to actually defray this costs, uh, the workshop cost itself. Okay, so I will be leaving this link down later also, so you can actually register interest for my upcoming skills future workshop. Okay, so I ongoing. Okay, we haven't planned for the next skills future workshop. I believe it will be in April, but you can register interest first, and once we have enough numbers, we will open up for registration, the actual registration. All right, so this is it for me. Now I will move on to the FAQ. Sorry, I've taken up so much time. Now it's 8:30, so maybe just 2 or 3 questions lah. Okay.
Sure.
Thank you.
Thank you, James. Yeah, you can leave that slide on, so that if anybody is interested, you can just go ahead and type in the links, so that
Okay.
you can check out what James has to offer. Okay, so if you have questions for James, can you please type into the chat box you see on the screen? So you can scroll, if you're using a mobile device, you may need to scroll up or down to look for a chat box. And if you're using the web browser on a desktop, then you can just type it into the chat box on the bottom right of the screen. James, you want to go back to that slide instead of this tunnel vision?
Oh, okay, fine.
Okay, can. Okay, yeah. So if you have questions for James, please type into the chat box you see on the screen. Okay, so while attendees are typing in the questions, if any, I have a few questions, James, if you
Mm.
don't mind.
Yeah, sure.
Okay, I noticed that your stock pick is quite unusual.
Mm.
You know, unusual as in they are not the very the mainstream,
Yeah,
right? So, is there any reason, like for example, in your Singapore stocks, you pick Nanofilm, Raffles Medical, and Huapa. Well, Huapa, I only remember them for that that
Tiger
that no, that's very scary place.
Oh, yeah. All
Yeah,
demolished
that
already.
I don't know what you call that, man.
Yeah.
So, uh, how are they as a stock? I mean,
Okay.
you think they have
Actually, very good question. I actually cracked my brains to come up with this more of like out of the mill stocks because when you go and look at analyst reports, or when you look at the stock prices in the STI index, or even if you listen to whatever other people talk about stocks, right? It's always the same thing. REITs lah,
banks,
blue chip stocks lah. Yeah,
SIA?
yeah, SIA, like Sheng Siong. So I actually did some research lah. So I find out that I don't want to just cover the mainstream stocks. I want to provide a bit more value lah for those who come to this webinar. So I did some research, and these are the stocks that I like personally. So it's also not that abstract in the sense you have Raffles Medical. So is the share price has come down by a bit. I do see some kind of a value or support area lah. So this makes me why I want to pick these few stocks. Yeah.
I see, I see. Are they more, you think they are more for capital gain or more for dividend?
I think Raffles Medical will be both because they do give out dividends as well on a constant basis. For Nanofilm is definitely capital gains because they don't give out dividends. For Hopa also both very stable. They also give dividends, so it's both lah.
I
Dividend
see, I
growth
see.
kind of thing. Yeah.
Okay. So for US, you picked Google, McDonald's, and Shopify.
Yeah.
So you didn't you pick any of the AI, I know the other Mac 7.
Oh,
So
so
any reason for that?
same thing lah. Okay, so alphabet. I didn't want to choose all the Magnificent Seven, so I decided to just pick one, which is my favorite is alphabet. So I decided, for the other two, why not same thing lah. I go and think of what is maybe a eye opener for webinars. I mean for the attendees lah. So one of it I personally like is McDonald's. I Every time I just use the app lah, so it somehow just pop up in my mind. Yeah, I always use the McDonald's app lah for deals, especially when nowadays high inflation, right? Why not use McDonald's? Always got deals. And for Shopify, because personally my wife likes to shop in the stores, the online stores, all these blog shops, or even just the kind of online blog shops lah. They all powered by Shopify. So I did some research that like Love Bondito is actually by Shopify. When my wife shops for clothes at Love Bondito, I'm checking out whether all this translate to growth at the Shopify itself. Yeah, so I decided to share with all of you lah about Shopify. Yeah.
I see, I see. So, thanks for answering those few questions.
Yeah.
So in your view, do you think that the interest rate will there be, that many cuts as expected, or the inflation will stay high and the Fed will not cut so soon?
Um, Personally, I think that the rate cuts won't be as many as what we think. Maybe won't be as, because when they increase, right, it's stock markets are like that. When they increase very slowly, right? Then they drop very fast. But interest rates, I feel that it's the other way around. So when you increase interest rates, when the Fed want to increase interest rates, they go up very fast. Every meeting they will increase the rate. But when it comes to cutting the rate, they won't go so fast. The reason is because they want to see what is the impact. Like let's say I cut 0.25%. I want to see the impact. Where will it cause any trouble? Will it cause any big recession? If not, then maybe next quarter I cut a bit more. I cut a bit more. So it is like the inverse lah for stock market. So personally, I think that it won't be as aggressive as what a lot of people will think. Like, yeah.
I see, I see. Thanks for your answer for that. So, in your opinion, just now you mentioned about the 4% dividend portfolio that you're looking at, right? So,
Yes.
but now, the T bills or the money market funds are giving around that kind of figures.
Mm.
So, do you think that it's still worth it to look for stocks to generate 4%? Why not
Yeah,
just
very good
T bill
question.
and chill?
Yeah. Very good question there. Yeah, to be honest, right, I also looking at the T bill. Actually, I want to do one more YouTube video about fixed deposit and T bills next week or next week. Yeah, so I've been looking at them. Personally, I mean, I have a lot of uh, friends lah also looking at this kind of low risk investments. But I want to stress that this is not the norm lah, in the sense that you know if you look at the just the past few months, the rates are also coming down by a bit. The fixed deposits rates by the banks, last time they even stretched until 4%, right? I think there's a time close to 4%, but it's gradually coming down. And I think yesterday when I went down to the branch itself, I actually saw that they have really dropped to 3% or 2.9%, around that region. So I don't believe that the T bills will continue at that 3 point something percent for long. And when I talk about 4% retirement rule, right, I don't just focus on like 4% dividend yield. So there are a lot of stocks with maybe 5%, 6%. On top of that, because they are able to give out such high dividend yields, they will be able to grow their stock price returns. So that means like for example if I were to invest in Raffles Medical at $1, they give maybe 3% or 4% dividend yield. If their share price goes up to $1.20, that's already a 20% capital gain, which you will never get it from T bills itself. Yeah, so uh, if you were to go for total returns, capital gains plus dividend yields, that will definitely be exceeding the T bills by a wide margin. Yeah.
I see, I see. Understand. Okay, great. Thank you, James. That's all the questions we have for you today. So, thank you so much for your time. Any last words for our attendees before I hand over to the next speaker?
Yeah, I just want to say a very big thank you to all the attendees who have just joined this webinar. Once again, if you want to find out more about other stocks, be it Singapore stocks or US stocks, right, just join my YouTube channel. And every time I have a new video, actually, I just published one today, I think 1 hour ago. So just type it inside the comments lah. Just let me know. Right now my channel is still very small, so if you have any stock that you want me to analyze, right, I will do it for you lah. So like let's say you want me to go through Singtel, I will just do it in my upcoming videos. Yeah. So thank you everyone for attending this webinar. Yeah, thank you Richard as well.
No problem. You're most welcome, James. Thank you for your time. And now I'll hand over the stage to our second speaker for today, Mr. Ian Low, who will share with us his market outlook and what he plans to do in 2024. Ian, the stage is yours.
Hi, everyone. You can hear me?
Yes.
Okay, give me a moment while I try to share my screen.
Are you okay, got it. I can see your screen.
Yeah, you can see, everyone can see.
Good.
Before I start, maybe a couple of comments from just now. Wow, it was good sharing by James. He basically went from, I think, top down. And I realized that for myself, it's like a bottom-up sharing. His is top-down, all right? And one interesting fact is that Hoppa is almost 30% owned by the UOB's We family. So this is an interesting fun fact. Is the UOB family owns 30% of Hoppa. And I'll be covering a lot on interest rates and of course T-bills and SSB today. All right. Okay. Okay. Thank you everyone for joining me. And time passed so fast, and 1 year has passed already. I have 1 hour with you today. We are starting late, so I must blame James for ending late. All right. So guys, stay with me until 9:45 if it's possible. All right. So now this presentation is for people who are really lost about the market, what to do. And I agree it's a difficult market to invest, all right? And I hope that this short talk today will give you some ideas and to clarify all your doubts about what to do about this market. I will share with you my personal plan for investing in 2024, all right? Oops. All right, introducing myself, I'm Ian Low. I invest primarily for passive income. I do invest in other kind of stock, but primarily I focus on corporate bonds and S-REITs because of the passive income. All right, maybe I'm too lazy to trade, and because I'm lazy, I prefer to have passive income. I'm a remiser with Maybank Securities. I'm also the secretary of OTCS Online Traders Club. And of course, with every presentation, there's a disclaimer that today's presentation is all my opinion. It is not intended to ask you to buy or sell any stocks. I'm simply sharing with you my plan for 2024. All right. Please know that all investment contain risk and you can lose money. All right. In 2022, S&P performed the worst. All right. Singapore, in fact, gained. That was 2 years ago. And 2 years ago, S&P actually beat a loss to Singapore market. One of the few times that STI beat the S&P, and Hong Kong went -6. And what happened last year? Last year, 2023, S&P went up 24%. Singapore did not move much, all right? So it went up, it went down, and it's back to zero, all right? Because 0%. And Hong Kong went down a further -13. They are really in bear market. Now, this slide is meant to tell you that US inflation is forecasted to go lower this year, all right? You take a look at my mouse, all right? Here is 2024. This is US inflation. It is somewhere about 3%, mid threes. and it's expected to go lower. This is according to the trading economics forecast, all right? And with the inflation that seems to be coming down and not increasing anymore, everyone is speculating that the Fed fund rate will be reduced. In fact, the market, you can see this faint line here, all right? Faint line here is expecting 3 rate cuts in 2024. Each rate cut to 0.25%. The Fed have guided us on 3 rate cuts, but the market thinks that they may be up to 6 rate cuts. All right, that is why the market rallied from November and December, and even in January. All right. So this is the dot plot. All right, I shall not explain what's dot plot, but dot plot is, in one sentence, a forecast of over the next 2 years where the Fed guides the interest rate over the next 3 years. Okay, currently is 0.25% to 5.5, and next year is expected to be 4.5 to 4.75, and 2025 the Fed rates may be 3.5 to 3.75, and 2026 2.75 to 3%. This is guided by the Fed committee, all right, the Federal Committee. Now, this is the forecast by them at this point. Please know that a forecast is this forecast. In fact, I'm very skeptical. For example, if you ask me, will it rain tomorrow? I will tell you, yes, it will rain tomorrow, because for the past 1 month, it has been raining almost daily. So it's very easy to forecast tomorrow. It's very easy to forecast tomorrow interest rate will stay the same. The Fed won't do anything. But for the rest of the year, when the market changes, if I have to ask you to forecast on 1st of June, whether it will rain or not, how are you going to answer? All right, it's impossible to answer whether is it going to rain in 1st of June. Okay, I can only say, oh, based on today, and it's impossible. All right, so but this is a guidance from the Fed, and personally, you will see later, this, in my humble opinion, if the Fed really does what they say, this, I think, is a good good situation. All right, it's a good situation because it's a gentle lowering of interest rates. Okay, this is, and it'll be unlike anything that the Fed has done in the past. In fact, usually the Fed doesn't do such gentle lowering. In most of the time, in fact, like 90% of the time, they are very fierce in lowering interest rates, fast and furious. All right. Now, this is the bullish view. That is what everyone seems to be thinking now. The market seems to be thinking inflation is under control. Interest rate cycle has peaked. It can only go down, and it will go down from second half of 2024 onwards. Interest rate to fall slowly over 3 years or more. Now, this is a good scenario. All right. The Fed likes to use this word now, soft landing. You see this word, soft landing. Another word that they use is higher for longer. All right. Soft landing, higher for longer. What are they doing? They are implying that, hey, when GDP is strong, they can still keep the rates higher for longer. When consumer spending is robust, they can continue to keep the rates. Where if right now there is very high employment, they can keep the rates. And when they see something going wrong, they will cut rates fast to avoid the catastrophe. But you shall see later, I think you will likely the end result is a recession. All right. Cutting, I will show it to you soon. The interest rate falling may not be good. It must fall slowly. If it falls fast, it's no good. So we have to watch out for this coming year. Now, what could possibly go wrong? All kinds of geopolitical events. Look at in the past 1 year, the start of the year, there was a Credit Suisse And then there was the Silicon Valley and First Republic Bank going bust. All right. What they did was that they bet on long-dated bonds, bought too much of these long-dated bonds. And when interest rate went up, the bond prices went down. And when it was time to mark to market to reflect the paper loss, the bank was insolvent. All right. So now, 2024, what could possibly go wrong? I'm going to show one scenario that I see is a potential. It may not be this scenario, but there is many other potential scenarios that I would not know. All right. Now, this chart, I'm not too sure whether you can see. I would like to ask you what is this stock chart? The stock is US Manulife or Manulife US REIT. All right. Many investors in Singapore invested in it, and it dropped from $1 to 6 cents. All right, over the last 2 years, $1. If you had paid $1 for it 2 years ago, now it is 6 cents only. All right, and many people may think, hey, this is just US Manulife. But how come? Why did it happen? Could it happen to other companies? All right, we know that US Manulife in 2022, their gearing was 43%, and now their gearing is 55%. SGX only allows up to 50%. All right. So in fact, 45% is dangerous, 50% is not allowed. So now it's 57%. And why this situation? It was because when they borrowed money from the bank a few years ago, interest rates was low. When interest rates was low, the banks valued their properties at a high price, allowing them to borrow more. And last year, 2023, the valuation of the properties that US Manulife holds was valued lower. When they value lower, the gearing changes. It's like, in a sense, a margin call if you're holding a margin account, when your collateral value decreases tremendously. All right. Now, look at this. This chart is the US average monthly prime lending rate. It is the lending rate, is average interest charge on short-term loans by commercial banks. Okay. And you see here from 2022 onwards, from 3%, it went up to above 8%. All right. This is what in US, you want to borrow money to renovate your home, you will be paying 8%. All right. But not only in US, in Germany, from 2022 onwards, from 2%, you want to renovate your home, you'll be 6%. You want to borrow money to renovate your home, from 2% to 6%. So it is not just in US, but I'm seeing it in Europe also. All right. And it will affect more than just US Manulife. So this is the possible black swan event that I identify. In fact, Nassim Taleb, who is the author of the book Black Swan, said in September 2023, he said this. He said that more than 100 trillion in real estate valuation, but we are not at 3% mortgage anymore. We are at 7% and going north. That was last year. It was 7% and going north. All right. And okay, this is a comment made by NBER. NBER is the National Bureau of Economic Research in US. All right. 15% of all CRE stands for commercial real estate. 15% of all commercial real estate loans and 45% of all office loans are underwater. Underwater, you can interpret as margin call, or you can interpret as what they are borrowing now is more than the value of their properties. So in the past, when they are allowed to borrow, it was because the valuation of the properties was high. But when they when interest rate went up, the value of the properties dropped, and now their loans are more than the value of the properties. All right. Now this is what's happening now. And NBER made this comment that up to 385 US bank could go bankrupt from commercial real estate risk, from this risk alone. So are we going to see something like that if the Fed do not reduce interest rate and say higher for longer? Will we see this? I have this slide because just for the sake of those people who are holding certain REITs that are based overseas and whose gearing is above 40%, all right? Besides Manulife, 57%, Prime US REIT is 44% on the borderline now, ARA US Hospitality REIT, now Elite Commercial REIT is 45%, this is mainly in UK, all right? Cromwell European REIT, 41%, United Hampshire REIT 42%, Lipo Malls 43%, even CapitaLand China Malls is at 42%. I think, okay, no doubt the properties in China, the prices of properties in China is coming down, but the Chinese interest rates are coming down too. It's already down and expected to go down further. So this may not be that big of an issue, but the rest of the European and US real estate companies, that may be a problem if interest rates do not come down. All right. Now, this is the Fed fund rate for the past 70 years. 70 years, huh? On my left side is 1955. And here is 2024 now. This is the latest, all right? So right now, the Fed rate is high now. It's high. It went up here and it may be coming down, all right? Now, what is the significance of this chart? I want you to note something. Every time the Fed rate comes down, almost always it leads to a recession. All right. So now we think that it will come down the Fed rates. Now look at in the 2019 to 2020, when we had the COVID, when the interest rates start coming down, this bar here, this gray bar here is a recession. All right. In 2007 or 2006, 2007, all right, when interest rate starts falling here, all right, it led to a recession. Okay. And somewhere about, I think about 2003, I think it led to a recession. Interest rate falling and led to a recession. And I think this was caused by the SARS, all right? Going back further, okay, before that, just know that not every time, you see, sometimes interest rate fall gently, it was okay. Any gentle fall of interest rate is okay, there's no recession. But when interest rate fall fiercely, it will lead to a recession. All right. Look at this, interest rate falling down, leading to a recession in the 1990s. All right. So you go back. Whenever interest rates fall fiercely, all right, look at the gradient. Whether it's in school, in maths, in school, the gradient of the slope. When it's a steep gradient coming down, interest rates are falling steeply, and when it falls steep and fast, very likely it will lead to a recession. Why? Why is it like that? Now, it doesn't mean interest rate fall lead to a recession. It doesn't mean that. Why is it like that? Interest rate falls, this is caused by the Fed, because Fed controls the interest rate. When interest rates fall, is because the Fed saw some economic numbers that they do not like. When they do not like it, they saw a possible problem, they quickly reduce the interest rate. But it's not in time to save the country. The recession happens first before they failed to to prevent the recession, all right? They failed to prevent it. Okay, so interest rate fall doesn't directly lead to a recession. It's because a possible economic event was coming, and that is why the Fed reduced interest rates, which leads to a recession. All right. And I think they're slightly related to interest rate. All right. Now, this is theory. All right. Before I go on, I need to teach one step of theory first. Okay. So this is yield curve. All right. This is a yield here. This is by percentage yield. And the years of maturity. All right. That means it may be 1 year to maturity, 2 years to maturity, 3 years to maturity. Now, this is called a yield curve. It is this way. There's the chart may be this way. The chart may be this way. Basically, my question to you is, which graph is a normal yield curve? It is the one on the left. The left one is the normal yield curve. The right one is inverted yield curve. Okay. The other thing I need to teach you here before I continue is, on the left side, positive yield spread. On the right side is negative yield spread. What is this? All right. Now imagine, I will tell you, this point here, this point, this value here minus this okay, so this point here, and there's a point here, and there's a point here. This value here minus this value here. In short, actually, I'm trying to tell you that I'm a bad teacher. A 10-year rate minus a 2-year bond rate. A 10-year bond rate minus a 2-year bond rate. Do you get a positive number or a negative number? So a 10-year bond rate minus a 2-year bond rate, you get a positive number here. In this case here, a 10-year bond rate minus a 2-year bond rate, you get a low number minus a big number, you get a negative yield spread. All right, I move on. So the question is this. This is a US yield curve at this moment now. Is this a normal yield curve or inverted yield curve? Unfortunately, I cannot hear you. This is, yes, you are right. This is an inverted yield curve. Now, this is not normal. Most of the time, it should be a normal yield curve, but it has been like this for the past 2 years, all right? Now, the short-term bonds, short-term treasury bills are giving a high interest rates. In fact, the long-term bonds and the long-term yields, the treasury bills are giving a lower interest rates. This is not normal at all. All right. So from this chart, we know that our market now is having an inverted yield curve. It's not normal, and it's a negative. It's a negative yield spread. Okay. Now, notice this. This is a 10-year yield spread chart. 10-year minus 2 years. Okay. When it goes down below the x-axis here, this is a negative yield spread. When it goes above, these are positive, negative yield spread, negative yield spread. These are times of the years that it has negative yield spread, from 1980s to the now currently. All right. So you see now, since about 2022, it is negative yield spread. All right. Negative yield spread here. And over here, somewhere in 2019, it touched it, went below. You cannot really see it yet, touched it, and it bounced up. And it led to a recession. All right. In 2007, 2008, there was a negative yield spread here, and it led somewhere in 2006, 2007, and it led to a recession here. All right. Somewhere in 2002, sorry, this is for 2000 and 2001. It was a negative yield spread, and it led to a recession. You can go back forth. Every time, every single time there was a negative yield spread, always a recession will come sooner or later. Not immediately. It may take a few months. It may take 2 years later. But a recession has always come after a negative yield spread. So what is it now? So I have this. Give me a moment. I cannot remove this. Give me a moment. Okay. All right, no choice. Let me adjust. All right. Okay, inverted yield curve or negative yield spread eventually leads to a recession. Okay, so a recession, is it coming? My question to you. Right now we have an inverted yield curve. Will there be a recession? So for a bullish market, we want interest rate to fall very slowly. And for this coming year, I will be watching out for the reason why the Fed wants to decrease interest rate. It's very important to know the reason and why they are doing it. All right, and this leads on to SGD T-bills. Many of you know that I love SSB and T-bills. I think 1 year ago, I was talking about SSB. Today, I shall talk about T-bills. All right. Now, just now, it was the US yield curve, and this is the Singapore SGD yield curve. We have very high 6-month T-bill because of this chart. Do you see that when the 6 months and up to 1 year, when 6 months and up to 1 year bonds, the interest rate is very high. The further down you go, interest rates of the treasury bills or of the bond is lower. This is abnormal. It is not supposed to be like that. In fact, it should be the opposite. Most of the time, normal is long dated bonds, the yield is higher, short dated bonds, the yield is lower. But now it's the opposite now. It's a weird market. In short dated bonds, interest rate is high. That is why most of us, I dare say a lot of us, because this OTCS, Online Traders Club, we are aware of what's happening. Most of us are putting money into T-bills now because we see it's like, wow, it's a good opportunity. This chart is the 6-month Singapore government bond yield. All right, 6 months. So it is like a T-bill. It's like a T-bill. All right. So T-bills in the past, right now we can get, today the T-bill for the 6 months was 3.7. All right, 3.7. So this is not the latest. All right. I took it from Trading Economics, which is not updated. So, and right now we have high yield for our T-bills. But one day, our T-bills is going to drop to low numbers. One fine day, all right? So this situation will not happen forever. Just know that it is going to change. So what if T-bills falls below 3%? Can I ask you investors, for those who are investing now in T-bills, what are you going to do? Fall below 3%. Or what if it falls below 2.5%, below your CPF rate? What are you going to do? All right? What would you do? I can bet many of us would invest the money into the stock market or put the money in something that can give us a better return. Correct? Am I right? Now, why am I saying this? Is because, can you imagine one day when T-bills drop to very low, there is a in US alone, 6 trillion US cash hold that can fuel more US stock gains as the Fed pivots. When interest rates fall, the T-bill yield fall. In US alone, there's 6 trillion of cash waiting to deploy to the stock market. All right, there are still lots of money sitting on the sidelines waiting to be invested. So this is good for those who are bullish. All right. Now, for myself, I will use T-bills and SSB, and they are the ideal tools to build my war chest. All right. I still remember in COVID, When DBS dropped to 22, I bought. Dropped to 20, I bought. Dropped to 18, I bought. Dropped to 16, I bought. And then I ran out of money. Fortunately, I bought. It went to DBS 1 went to 16 during the COVID. I bought and I ran out of money. I actually ran out of money to invest. All right. I told myself it mustn't be like that anymore. All right. And I want to build my war chest for the next recession. And I'm doing it now. And the tool that I'm doing it with is using T-bills. So frankly, even if T-bills SSB gives me below 3%, I will still put my money there simply to prepare for the coming recession. All right. Now, most people, when they invest, they simply, hey, I have $100,000, $60,000, whatever thousand, I will throw my money into to buy T-bills now. And 6 months later, I would see whether what is the yield of the next T-bill, and then I will decide whether to do it. But for myself, since long ago, 2 years ago, when this T-bill started, all right, I started to put in small amounts of money. What I did was this. For example, if I have $60,000, all right, January I put in 60. I do not put in 60,000 at one go. I put in 10,000, and I still keep the money in my bank rotting, doing nothing. And then the second month I put another 10,000. The third month I put, okay, why 20? Because my savings increase. When my savings increase, I will 10 plus another 10 of savings, because I save the money from what I earn as a reminder. So I put down the 20,000. And in April, the money in my bank, I put 10,000 and 10,000 and 10,000. And in July, when the January T-bill matures, why is it zero? Because at that month, I saw the stock market drop. When stock market dropped, I deployed it. I used the $10,000 to deploy it, and I put it in. And I have a $0, all right. And the following month, why 10,000 mature? I only have 5,000 because I use 5,000 to invest in the stock market. Why I use 5,000 and I leave only 5,000 here? I put in the T-bill. I bought another T-bill, 5,000, and the other 5,000 I put it into the stock market, because the price went up a bit, and I'm not willing to put another 10,000 to buy the stock. So I put less money in. This is what I'm doing. All right. So in fact, I don't just do this. I spread my money out such that every single 6-month T-bill, every single one I participate. All right. I will participate in every single one at whatever big or small money, because I want to dollar cost average. And I'm getting ready that I will make a decision every time that a T-bill matures. I will decide, should I put it into the stock market, or should I put back and buy another T-bill? All right. So this is, in a way, T-bill laddering, and it is to prepare myself that I will always have money for the future recession. All right. Hope that this idea helps you. Now, what I thought through, these are the drivers for 2024. All right. Why 2024 should be a good year is because tourism is expected to be back to 2019 levels. All right. The people are traveling now. Hotels are yet to fully recover, but they may be recovering. Aviation too, improving inflation. The Fed may pivot. Resilient global growth. 4th-year presidential cycle. Just now, James Yeo mentioned about the elections, upcoming election this year. In November, but US will elect the president. Now, usually, most of the time, by statistics over the past 100 years, is that the 4th-year presidential cycle, the 4th year, is a bullish year. Why? Because the incumbent who is running for the next, for this coming election in November, wants to show that he did well. because you want to show that he did well. He create the circumstances in US so that everyone is happy with him. All right. So usually it does well. And cash on sidelines, as I said, there's lots of money parked in US, in Singapore, all over, in fixed D, in T-bills, waiting to deploy. And these are the drivers for 2024. Now, what are the risks of 2024? When the Fed keeps saying higher for longer, they keep saying that they will look at the economic numbers. And a Fed rate fall may lead to a recession. Just now I shared with you. Inverted yield curve eventually lead to a recession. And you know what? In today's world, all kinds of black swan events, all right? As I said, there was a Credit Suisse, there was a First Bank, First Republic Bank, Silicon Valley Bank, and all these were opportunities to buy. So what I'm trying to tell you that this coming year, if I tell you that now is a good price, but actually you don't need to buy now. You should wait for the price to drop 15-20%, which it surely will, because there will be events this year that allow us to buy. All right. Economic event map. Now, this I'm sharing with you what's in my mind. I'm forming a map in my mind, what is happening, so that I'm getting ready for it. So I'm transplanting my mind into this slide so that you can look at the slides and see what's on my mind. All right. So during COVID, the prices dropped. There was a low in March 2020. All right. You can see this like a stock price. Stock price dropped because of COVID. All right. And it led to a recession. Then there was a recovery from COVID, very fast and furious. All right. And then in March 2022, the Fed started to hike rates. In fact, about 4 months before, they told the world, somewhere in November 2021, they told the world, I'm going to increase the interest rate. 4 months later, they started to increase for real. All right. So it dropped. And now the Fed seems to be guiding, we have reached peak rates. We may, and because they may be dropping rates this coming year. So market rally. All right. Now going forward, now this is here. We are here today. Is it going up or is it going down? Personally, drum roll, I think it will go up. All right. I think it will go up. Of course, it will not be a straight line up. It will be jagged, up and down. But personally, I think this year, I think it's going up. All right. But eventually, this Fed pivot is a real pivot when they start dropping. I'm going to share with you when the Fed really start dropping rates, I'm going to sell my US portfolio. All right. Because I know a recession is coming. That's my plan. So I'm hoping I'm about 70% invested in the market, about 30% war chest. So I hope that my 70% of portfolio will go up, keep rising. I will add here and there, but I will not be too aggressive. And here, I will sell off my US portfolio, keep my dividend stocks, and hope that I can use my war chest to buy in 2025. All right. This is the map I have in my mind. So when I look at a chart, I'm looking at trading upwards, looking for dips, buy on dips. All right. All right. So S&P 500. This is a chart. Okay. Now what do I use? Every year I share the same indicators. In fact, I use the same indicators on every year, and I show the same thing. Okay? But just to share with you, this is a weekly chart on S&P 500, 89 SMA, simple moving average. Don't ask me why 89. I'm using 89. All right. So Personally, I think US will rise further. All right, it will not be a straight line. It will zigzag, make higher highs, higher lows. It will come down. I think it's a bit too high now. There will be a dip, and I'll be trading it forward. All right. What is this line here? This is MACD, and I like to use only the MACD line. I don't like to use the other lines. All right. So so meaning that when it's above one, I know it's bullish. When it's below one, I know it's bearish. So I got to be careful. If I were to buy here, I'm being a contrarian. So I need to be careful. Here above the MA, I will trade with the trend. Below MA, I have to use contrarian. So assuming if I buy here, I will not hold till here. When I buy here, the moment it bounces back up, I will sell. When I trade contrarian, buy low, sell low. Over here, buy high, sell high. All right. So anyway, S&P 500 is to buy on dips. For Singapore stocks, I will. Okay, first, can you tell me? Currently, this is today's prices here. Is it high or is this low? To me, I will say the middle line is somewhere here, somewhere the middle here. All right. This is the middle. All right. So frankly, it's high here. I wouldn't buy today, even though I tell you that it's okay. I wouldn't buy today. I want it to be extreme. I want my prices to be extreme. Sorry, some clients have bought today. All right, some of my clients, I'm a reminder here. All right, but this is your trade according to your style. My style is I want STI to be at the support. All right. So at least if it comes here, I will decide whether to buy. If it comes here, I will likely buy. All right, I surely will add. All right, here I will see whether at this point and at the rate section, I would think T-bills more attractive or my stock more attractive or my REIT more attractive. Over here, surely the blue support, I will go and buy DBS. I will go and buy the REIT. All right. And of course here also. And here, where is this? This is a COVID low. When it's back to the COVID low, yes, DBS at COVID low, I surely will buy DBS. All right. So I will average in at support. And I will use my war chest money. And war chest is now in T-bill. Keeping rotating and rotating, making a decision, a conscious decision each time whether to invest, to put my money in T-bill or put my money in the stock market. All right. For those who know, I have a little strategy to, I'm quite proud of it, a relatively successful trading strategy. I call it trading STI. This is a weekly chart, all right, of the STI. Basically, I use the stochastic, the fast stochastic line, and I'm using Bollinger Band at 20% period, a standard 2 deviation below. So my first rule is STI must touch the lower band at 2 standard deviation. It must touch. Then when there's a hook of stochastic, it's time to buy. So very nice STI. Whenever it's here, when it's here, it's a buy. When it's here at this point, it's a buy. Here a point is a buy. Here is a buy. Buy. All right. So it allows me to invest at a low. All right. Unfortunately, there's no sell. All right. Sell when you are satisfied, when you are contented. All right. We need the money. All right. So this is what I'm doing, trading STI. So today I tell you, although DBS is at 32, very attractive, I think I'll wait for it to come down when STI is somewhere lower. All right. Now, what about Hong Kong and China? I'm sure all of you will ask me about Hong Kong and China. Frankly, I'm at a point of giving up already. All right. You ask me, hey, I do have some shares in Hong Kong, China. It is really diarrhea. I'm sure you ask me, should I average in? All right. Answer is yes. Answer is yes. But let me cover a bit about Hong Kong and China. All right. Now, first thing, the thing about Hong Kong and China is that whatever you read from 2008 until 2023 in the Western media is always negative. Western media is always negative, and on the right side is the GDP of China. All right. So the GDP of China every year is positive, but the Western media is always negative. So no use to read about seeking alpha or the zero hedge. It's always negative on China. All right. This is the first point. Then what to look out for? What kind of news to look out for? I think today the number one problem in China is the China's residential property prices. All right. This is the chart of the China residential property prices year on year. It's a year on year chart change. So since 2016 to 2016 and onwards, all right, it has come down. China properties has keep coming down. In fact, the government will stimulus, push it up, come down. Government stimulus, push it up, come down. Government stimulus, push it up. No strength coming down. All right. This is the biggest issue right now in China that is affecting the consumer confidence of everyone in China. So to me, sliding property prices, consumer confidence, and the unemployment rate, the most of the university graduate have no jobs. All right. Somehow it's just affecting whatever the government does. The young people there are not having jobs. They are not employing. All right. The companies are not employing. So there is a problem of consumer confidence, even though the GDP is positive. Last year, 5.5+%. All right. Now, so what do I do? To me, the only way to invest in China and Hong Kong, all right, is to use the chart. All right. Of course, I give you an example. Currently, if you look at the chart of Hang Seng Index or look at the BABA chart or Hang Seng Index, there seems to be a BABA chart, a strong support at 60. All right. Now, yeah, you can say strong at 60, you can average in. But I think you are gambling. All right. If you go in there and buy today, you can average in, bring down your cost of BABA prices. But to me, it's gambling. For me, I will look at the chart. I will look at a possible reversal, and it's hard work. On my chart, I want to see where are the support lines. I want to see a head and shoulders, a double bottom head and shoulders, all right, with a bullish divergence. Then I know, wow, can buy already, can buy a bit already. When it makes higher, low, I will add. Cross moving average, add some more, all right. So this is what I'll do, all right. I will not just add because it's a last support, all right. Last support is the first criteria, which currently BABA and Hang Seng is now. All right. So anyway, Hong Kong is trading down, divide Cs. You are not seeing any of this because there's no head and shoulders. I'm waiting for head and shoulders. I'm waiting for bullish divergence. I'm waiting for higher highs and higher lows. There isn't. So there was an attempt over here. There was an attempt. All right. It fulfilled all of this. An attempt. It went up. Crossed the MA, but it came down again. Attempt failed. All right. The attempt failed. So I'm sure the Chinese government will push in the reforms, decrease interest rate to push again. But is it going to go up? Personally, the place that I will be very bullish to buy. Currently, this is yesterday's price. All right, Hang Seng. This is the current support here. We are near the last COVID low. All right. But personally, I think 120, 12,000. 12,000 Hang Seng is a very strong support because it's the 2008 financial crisis low, it's the SARS low. All right. If ever it reach here, all right, I think I will look at Hong Kong closely. All right. I have to prepare my mind. No, it's not easy when the stocks come down to buy. I will prepare my mind. All right. Okay. What REIT can I hold for the long term? For myself, if there's only two rules, I want to have REITs that has consistent DPU growth, and it must have strong sponsors, strong sponsors, preferably government linked. All right. And for me, I want REITs with preferably Singapore portfolio or as much like 70%, 80% Singapore portfolio. I will try to avoid hospitality trust. All right. So, for example, if these are the evergreen, I call it Cat A, like the COE, right? Cat A. If you today have not invested before and you want to know, ask me what REITs to buy, I will say that, hey, just buy these 8 REITs because these are the evergreen REITs. It will fulfill your criteria, all right? And you don't need to look at any other REIT. There are 43 REITs now, if I'm not wrong, all right? You don't need to look at any other REIT. Look at this 8 is enough, all right? So anytime these REITs fall, it's time for me to average in, all right? So now, I'm also looking at, I will call it Cat B REITs. I call it opportunistic, all right? And meaning that I'm still monitoring, I'm reading their reports, but I'm holding a couple of them, but I prefer to put my money. If I have more money, I will add to this rather than this. But for you who like this, I like these REITs, all right, for whatever reason, all right. So shortage of time, I cannot cover. Maybe I'll share with you on another day on a separate presentation. But I think these REITs are not that opportunities because they are here for a reason. Every one of you is here for a reason because the price dropped or because I think it's going up. It's here. But I still prefer to buy the Cat A REITs. All right. I move on. So this is what I mean by Maple Tree Industrial Trust, the DPU that they pay every year. 2015 and now they keep increasing. Very strong. All right. Even when interest rates are high, 2023, look at it. They decrease slightly, but they are still very strong. Maple Tree Law, 2023, interest rate went up, their expenses went up, but their earnings went up even more, and their DPU even higher. Maple Tree Pan Asia Comtrust also keep going up. This is trailing, so it's not close. 2023, even higher, even though interest rates went up. Capital DC, also DPU keep going up. All right, strong, very strong earnings. So this is what I mean. These are the REITs that I like. Okay, I shall move on. All right. Now, this is when to buy now. When to buy. I'm rushing a bit because of the time. All right. This chart is the S-REITs chart. All right. Of all the REITs in Singapore. And in fact, you can average in now. All right. But for me, I will not average in like that. For me, I'm looking at a technique of mine called the stochastic hook. Again, so it's a stochastic period 9, and these are the hook up. Hook up at when it's at the extreme. Hook up when it's at the extreme. So I will buy here. So it's time to invest. So now, if it's here, I want it to go further before I buy. But I will average in if I have the money, of course. I will decide, should I buy T-bills or should I put the money here? Okay, so again, Maple Tree, this is the price. This is the price where I will buy. The price I will buy. You can average. So of course, I don't have so much money to buy every time. All right. So as and when I have the money, I would decide whether to pump in the money. So I will only buy at the lows, trying to buy the lows of that period. Invest during the lows, not when it's high. All right. Likewise, trading STI to buy at these points here. I shall cover it on another day. All right. To explain to you the details. Corporate bonds. Okay, this is the last section. I just have a few more slides. Bear with me. 10 minutes, just nice. All right. This is the chart of 5-year government bond yield. So right now, if you invest in a 5-year government bond, you get about 3%. Okay. So today I have a client who bought a Wing Tai bond. So Wing Tai bond will give her 4.2%. So this is the yield spread. So when you buy a Singapore government treasury bills, it's 2.7%. Maybe you buy a DBS, maybe it's 3.2. A DBS bond, 3.2%. Maybe you buy a CapitaLand bond, 3.5%. Now, you're not satisfied with that. You want to take a bit more risk. Wing Tai at 4.2%, somewhere here. All right. So the more risk you take, the higher the yield. All right. Very important here. So MAS have a new regulation for subscribing to new bonds. For all brokers, every single broker and every single bank have to follow this. I repeat, for new bonds, IPO bonds, all right? So for primary market bond issues, only accredited investors can buy. For secondary market, anyone can buy or sell, all right? So meaning that, for example, today there's an IPO, only AI can buy, but tomorrow anyone can buy that same bond, all right, when it's trading already, all right? So to qualify for AI, you just need to submit statements to show that you have a net financial value above 1 million. Talk to me, call me, WhatsApp me, I can meet you to fill up the form and submit, all right? These are for my clients already. So very simple. All right, I have 2 pages of bond highlights. All right, so this is a Wing Tai bond. Hey, I just want to share with you. Every single year, whenever I show my bond highlights of what is to buy, the next day, the next week, the price always go up. Because I realize someone is using it to, brokers are using it to buy and the price went up. All right. Okay, so anyway, I didn't benefit much, all right? But anyway, I'm sharing again. This is what I analyze. To get a yield above 4%, you have to buy Wing Tai or OUE to get you above 4%. Anything government linked straight bond is below 4%, guaranteed. Anything straight bond are not perps. All right. But you buy a government linked perp, 4.68%. A perp you can. All right. Why do I choose these two? Is property. Property companies are at risk in 2024, remember? But because 88% of Wing Tai is in Singapore, their properties is in Singapore. 74% of OUE is in Singapore. So no matter what happened to their China or Indonesia property, hey, it's just 26%. So I know they will survive. They will survive any revaluation of the properties because they're 74% in Singapore, and definitely 2026 OUE will still be there. All right. All right. So next one, if you want to get a higher yield, to take bigger risks, all right. Government link, Mapletree North Asia Trust, 4.71%. CapitaLand China Trust, 5.45. All right. Why CapitaLand China Trust 5.5 versus Mapletree North Asia 4.71? Is because they are now 100% China and their gearing is 42%. All right. Whereas Mapletree North Asia Trust is now under Mapletree North Asia, under Mapletree Pan Asia Commercial Trust, which has a huge properties in Singapore. So they are under a huge group that is having like 90% in Singapore and 10% in China. So that is why the yield is 4.71 versus this. All right. Properties are totally different. Star Hill, little known company, is a REIT. It's a REIT in Singapore. You can buy the perp for and get 5.42%, 61% properties in Singapore. All right. Yep. These are if there's anything that you like based on what you share, my clients, and you want to invest, please give me a call to have a chat. All right. Unfortunately, it's either this or go and buy your T-bills. Just put your money in T-bills. All right, this is my overall plan for 2024. I will continue to build a war chest by laddering T-bills in preparing for upcoming recession. So you see, in my map of my mind, I'm preparing for a recession, but I'm still going upwards, still buying upwards, but it's good to have a recession. All right. I want to emphasize it's very important to keep some money to prepare for a recession. I can tell you, I'm so happy buying those stocks I bought in COVID period. All right. And I'm still holding them. All right. I'm so happy. Now, the other thing is this. US. To buy on dips. But I will exit when the moment the Fed announce the rate cut. I think I'll let it go up, of course. I think the market will go up for a few days and then it will come down. All right. They always say buy on rumor, sell on what?
News.
Sell on news. Yes, correct. Yes. Thank you, Richard. So when the news is out, you exit. All right. All right. And for S-REITs and STI, I will invest using stochastic hook or the trading STI on the weekly chart. Both of my strategy are based on stochastic hook, all right, on the weekly chart. And for China, I will watch out for reversal patterns at major support. All right. It is really a bear market. Bear market doesn't mean cannot buy. Wait for the reversal and trade the return to mean. It will return back to the mean. And when it hit the 20 to 200 moving average, you should exit. All right. All right. So average in when it reverse and take a quick profit so that you can lower your cost of entry. All right. All right. Thank you for everyone for listening. Please, if you like what you hear, subscribe to my website, wealthlions.com. I think since COVID, I stopped blogging. I will be continuing to blog very soon. And please also support me by subscribing to my Telegram channel. All right. So thank you very much. For anyone, anyone, and I mean it, you want to have coffee with me, WhatsApp me and contact me. Whether clients or non-clients. All right. Please contact me. I would love to have coffee with you. Thank you, everyone. And Richard, over to you.
Okay, great. Thank you, Ian. Wow, what a well jam-packed an hour, man. My brain feel very warm already. Thank you so much for your sharing. I think it's very comprehensive. That you shared what are your thoughts in your mind and what are your plans, your game plan for 2024. So for all the attendees who are in the room, if you have questions for Ian, please type into the chat box now and I'll ask him on your behalf. So if you are using the desktop browser, please look for the chat box on the bottom right. And then if you're using a mobile device, please scroll up or down to look for the chat box and type in your questions right now. So while the questions are coming in, maybe I can check with Ian about some questions myself.
Yep, go ahead.
Okay, great. So, I noticed that you are using the stochastic hook, right?
Yep.
So, are you saying that just want to confirm your time frame is always on the weekly, or you also look at the daily?
Weekly only. In fact, I look at weekly only. Yeah.
Okay,
100%
weekly.
weekly for stochastic hook and trading STI, both based on stochastic hook, is always on weekly only.
Okay, understand.
Yeah.
And then the hook must happen below the 30 lah.
Below the 20.
20.
Yes,
Okay. Below
20.
20.
Yeah.
Understand. Thank you. You are my sifu for this hook thing, man. Okay, weekly hook below 20. Yeah, hook up. Okay. So, and then I also noticed that your trading STI, you added the Bollinger Band. You have the Bollinger Band as a criteria. Do you have that criteria when you look at other charts like the REITs chart or the banks
Um,
chart, or just based on
Actually,
the hook on the weekly?
in dialect scales, you know like that this when it's stochastic, when it's extreme and it does a hook, all right, there is very high chance it will also hit the two standard deviation Bollinger Band. Okay, so it is just another confirmation. All right, both are showing extreme overbought. All right,
Oversold, you
both
mean?
oversold. Both are showing extreme oversold, and I will only do this. I will only do this on stocks that are solid companies, solid REITs, DBS Bank, Capital Corp, S&P 500 ETF. All right, because when it goes lower, I can do the next hook to average in. If it goes down even lower or the next hook, I am sure it will reverse and go back up and be profitable. All right. So usually when you look at the past history of the stochastic hook, even during a crisis, there may be the first hook lose money, second hook may lose money, third one sure will make already. All right. So and you continue to make. So there will always be a reversal. So you continue to perceive to persevere in the hook, it will surely reverse. All right.
Hmm.
But reverse only for good companies, not those all right. That's why I say I like government linked companies. I usually invest in government linked companies because I know it will reverse. I know it will reverse. All right. Yeah.
Understand. Yeah, I think that's a very important point. Can only bottom fish strong companies because
Yes.
the chance of them recovering is much higher.
Correct.
And one of the way to know whether it's strong or not guaranteed, but higher chance is that they are government linked.
Yes. Yeah.
Okay, got it. Okay, now let me turn to the questions from the audience. The first question comes from Ju. Okay, and he or she is asking, is it a good idea to buy S-REITs when the US indices crash?
Mm, okay. When US indices crash, it will prompt me to look at the STI. All right. And that will prompt me to buy the REITs. Actually, so I would say is indirectly. Yes, when US indices crash, I will surely, very likely, be using the stochastic hook to make the purchase to the every hook. All right. So you are right. But this is indirectly. So Ju, I think it's a good question. I will not say a yes for sure. I would say that indirectly yes. Yeah.
Understand. That means when the US, let's say the US crash, usually it will pull the world with it, right?
Correct.
So that's
Yes.
when the stochastic hook may form. So that's the
Correct.
time to look for the hook and then buy.
Yep.
Okay, understand. I hope that answers your question, Ju. And okay, Ju, yes, you're looking for the Telegram channel. It's right there on the slide. Just search for Wealth Lions in Telegram and join it. That will be the correct Telegram channel. Okay, let me see. Andrew is asking, the local banks current yield about 6%, which is not very common if you look into history. Do you think that we can continue to buy them now instead of waiting for vis-a-vis your recession expectation?
Very, very good question, and I speak for myself. I will just tell you what I think. All right. Personally, for me, for DBS, for myself, I haven't bought anything above 28. So at the price 28 and below, I will certainly sit up and look for entry. So 28, I may look and I may or may not go in. 25, surely go in. And as it goes lower, I will just keep adding. All right. Of course, for UOB, the price is slightly lower. UOB may be starting at 25, 23, 20. So start adding. All right. So that is for me. And even knowing the upcoming recession, this is what I'll do. All right. Yeah. So, but at this point today, at the price of 32, knowing what I know about the possible defaults of in US, all right. In the US, there are possible defaults in the bank, and when let's say there are some defaults in the bank, DBS price will surely fall. And I will look forward to the fall. All right. Of course, DBS will surely survive, and I have no problem buying them. I want to enter at a good price, and for me, good is likely to be 28 and below.
Understand. But then, okay, understand. Okay, good, great. Andrew, I hope that answers your question. And next question comes from Michael. Michael is asking if Baba split into 6 companies, can you still use the old Baba chart for trading? I think the answer is no, right? Just a quick answer on this.
If they continue, yeah, actually my answer is yes, My answer is yes. If the actual Baba chart continues to exist, and there is a chart that has all 6 inside that one company, the Baba price chart still stay there, I will use it. You know that I am very unique compared to most people. I think I'm one of the few people in the world who rely heavily on looking at the index. Personally, for me, I look at the index, the indices, S&P 500, STI, a lot. In fact, I can sell my stocks simply looking at the STI. That means that, let's say I have 5 Singapore stocks. I look at the STI, I can sell my 5 stocks. All right. Okay. I don't need to look at the chart of my 5 stocks. All right. So in the same way, if Baba splits it into 6, you can look at the main chart and use it as a proxy to make your entry.
Right.
Yeah. That is this is me. I am quite unique compared to most. I think most people don't, but this is what I do. So I will do that. Yeah.
Understand. Okay, Michael, I hope that answers your question. Okay. I think that's all the more question. That's all the more pertinent questions to your content that you have shared today, Ian. And if any of you have more specific questions regarding specific stocks or their portfolio that you want to consult Ian for his help, please feel free to contact him. And the contact information can be found on his website at wealthlions.com/contact. Submit that form and then you can reach out to him. Okay, and that's all for our OTCS Market Outlook this year. And we will have more events coming up, whether is it webinar or in-person sessions. So if you'd like to be kept posted, please remember to join the Online Traders Club Telegram channel. So Ian, do you have any last words with our audience?
Thank you for joining me today. All right. I hope to see you again. So when you guys see me out there at MRT or attending various events, please say hi to me. All right. Thank
Okay,
you.
wonderful. Thanks, Ian, and thank you for your sharing. And thank you, for the audience, for staying with us till now. And I will see you at the next event. Good night, everyone.
Good night.